The markets are about to break out, interest rates are going up and prices keep on rising. Inflation is out of control. What should you do now? How should you react? And how should you invest? What's up everyone, my name is Joris, welcome back to my finance channel. It's full speed ahead for the European economy now that the pandemic safety measures are being lifted. Prices of products and services are going up fast. As we have seen in the last few weeks, the European economy is recovering fast and the newest press release of market proves just that. This month, the numbers of June are even better than before. The PMI index, the Purchasing Managers Index, is an index showing how the economic activity is performing. It shows us a result of 59.2 points, while only 58.8 was expected. A PMI number of 50 or higher translates to a growing economic activity. And with a PMI of 59.2, the economy in Europe is growing at the best rate in the last 15 years. The index for the European manufacturing stands at 62.4 points. And it shows that our manufacturing industry keeps on growing. Manufacturing remains the leader of the recovery in Europe, as you can see. And on the other hand, we can see the services PMI with 58 points coming from 55.2 points in May. Services are growing at their fastest rate since 2007. The economy is growing again, and it shows in the numbers. But this growth is supported by the lifting of the pandemic measures and the fast vaccination programs. In most European countries, vaccination rates are already far above 60%. Remember, specialists would expect herd immunity if you reached 70%? Well, I'm talking about first vaccinations here. But we are taking control of the pandemic, and we can allow our daily lives to pick up again. This comeback of freedom also brings along more demand for products, and thus it will push inflation upwards. Inflation in Europe hovers around 2% now, so no exuberant numbers just yet. But in the USA we can see inflation rates of 5% for May. People start spending again, and production companies have trouble keeping up. There are shortages in commodities and labor forces, and this drives up prices in the production chain and it raises prices for the end customer. It pushes inflation even further up. Wood, for example, is one of the commodities that has been going up exponentially, tripling in price since the start of this year alone. And luckily, it's just starting to come back down again. Another example is shipping prices. They are also on all-time highs right now. It now costs over $10,000 for a shipping container to be transferred from Shanghai to Rotterdam. And those prices used to be under $2,000. So this mega inflation in shipping prices does have its effect on the production prices. The supply chain is getting more and more expensive. Because of these high transport prices, it becomes more costly to get your materials to you, and your costs will be higher as a company, and higher costs means lower margins and less profits in the end. Since production companies are relying on the shipping and the shipping prices, they only really have two options. They either take the higher prices as costs for the company and maybe start operating at a loss, or, and most companies do this, they raise their prices of the end products. This raise in prices throughout the whole supply chain from commodity to end product causes the overall inflation. Now, should you worry for the coming inflation? Well, most experts see this rise in inflation levels as a temporary effect. The economy is open again, demand is growing, but production lags due to the messed up supply chains, as we said just before. This is temporary and production will come back, and demand will die down again, pushing the inflation levels down with them. And even the shipping prices will go down again. With these kind of shipping prices, more competitors will come into play and more supply will push down the shipping prices. It might take a while to get back to the efficient and low prices of under 2,000 euros per container, but it won't stay at these current levels for long. It's all supply and demand really. Last year, demand dried up due to the pandemic, so companies started producing less, so supply then leveled with demand on a lower level. But now the economy is opening up again and demand surges and supply just can't keep up. It's all a matter of time, and depending on how long it will take for supply to catch up, prices will continue to go up until this new equilibrium is reached. Inflation can still rise from their current levels, but it will lower to acceptable levels once this balance in supply and demand is restored. These acceptable levels translates to an inflation of 2% yearly, and the European Central Bank has this inflation rate as a guideline. And they will try to support the economy, the European economy, just to keep this inflation around the 2%. An inflation percentage of 2% means that the value of your money goes down by 2% every year, or the average price of all items rises with 2% per year. I have talked about this in previous videos, so I won't go into this any further here. The European Central Bank supports inflation by injecting money into the economy. They can do this with bond buybacks, like they have been doing in the previous years, and they are continuing to do so. But they can also directly give an amount of money to the governments, to every country, to invest in their economy. This economic support makes sure that the GDP, the gross domestic product, rises, and the countries individually thrive. The European Central Bank now promises a money injection of nearly 6 billion euros in Belgium alone, to support the digitalization of justice, the investing in hydrogen energy, real estate renovations, and the release of 5G services. In total, the European Central Bank will hand out up to 750 billion euros to all European countries combined, but only if they reach the promised targets. These financial supports are straight money injections as well as cheap loans to the governments. Some of them are even loans with a negative yield. So in the end, the governments are making money because they have to pay less than they initially loaned. All this aid, together with the shortage of products and labor forces, might keep inflation levels high. And when the inflation keeps rising and stays on higher levels, we will need to adapt our investment strategy to overcome the devaluation of our money. As we know, inflation eats away your cash money. Money in bank accounts has no positive returns, apart from the 0.11 return on investment on your savings accounts. This is required by law, but I'm not expecting it to be there very much longer. But inflation is often higher than this 0.11%, and it will make sure that you are effectively losing money over time. As the European Central Bank tries to put the inflation around 2% and you're only getting 0.11%, well, you're almost losing 2% yearly in inflation alone. So you really need to alter your strategy and adapt to the changing times. Investing in real estate or in stocks will make sure that the money that is losing value now is then instead making you money. Real estate and the stock market are historically known as good protections against inflation. So if you're looking for a sign to start investing, well, now is as good as a time as ever. So what are your thoughts about inflation? Is this effect here to stay? Or are we just overreacting and will inflation levels go down again soon? Let me know what you think in the comments below. If you have learned something, please leave a like for the YouTube algorithm, share the video with a friend to expand their knowledge as well. And if you want to stay up to date with the latest news on the European economy, or you are just interested in personal finance focused on a European level, you should really subscribe to the channel and hit the notification bell to be alerted when a new video comes out. It's free and you can always unsubscribe later. If you want to watch more of my finance videos, you can start by clicking one of them right here. I've picked a few especially for you. I thank you very much for watching and I will see you in the next video.